The very fact that we have to think and predict and psychically analyze, psychologically and with tea leaves and a crystal ball, what will Powell do? The fact that Powell or a central bank has this much power over our fates, the fates of theoretical capitalism or the fates of our country, says a lot about the dangers of centralized power.
Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Today, we are joined with Matthew Piepenburg, who has come on over to the house. Matthew is the author of the Amazon #1 Rigged to Fail and is a partner of Greyerz Gold Switzerland. So, Matthew, I want to thank you for coming over. How are you doing?
Very well, Patrick. It's good to be in Singapore. Sit down, throw some thoughts at each other.
Yeah, glad to have you here. First time guest. Usually I've been starting off these interviews with asking the question about your opinion on the gold price. Why are we seeing it move, even though it's a bit down, but all of a sudden we've seen volatility with gold in the past couple months or so?
Sure. Well, it's a very important question. It's on everyone's mind. Gold is certainly making what the fancy lads on Wall Street would call price discovery. It's just extraordinary. There are a number of reasons it's going up. There are a number of reasons to explain the recent corrections. They're minor corrections, in my opinion. At 30,000 feet, the most obvious answer to why is gold going up, and Egon and all our team would agree, is it's not that gold is going up in dollar price terms. It's the U.S. dollar is just getting weaker. That's the most generic. And then that really involves a history of currency debasement, which is throughout history and without exception, as I've said many times, when a nation, whether it's a monarchy, an oligarchy, a democracy, an empire, when it gets too over its skis in debt, inevitably, whether it's a Roman coin or a U.S. greenback, it ultimately has to, or in the Deutsche Mark or the Weimar periods, those are extreme examples, but they eventually have to debase their currency to monetize their debts. So there's a currency and an historical issue. There are very specific reasons the US dollar is demonstrably going to be weaker when you print trillions of dollars, or I say mouse click them at the Federal Reserve. That does have a debasement inflationary consequence throughout our history. When we obviously dethroned ourselves, when we decoupled from the US dollar in '71, that had an immediate impact on the dollar's strength over time. They tried to correct that by having a petrodollar in '73 and then a COMEX in '74 to manipulate the gold price and manipulate the dollar's synthetic demand through the oil markets. So those are important forces too. But even the COMEX has less and less physical reserves now to use as a permanent boot to the neck or a permanent short on precious metal pricing. The other big theme is no longer just a headline taboo. It's happening in real time all around us since we weaponized the US dollar. For whatever your views are on the war against Russia and the sanctions against Russia, it has forced friends and allies and neutral countries alike to rethink trusting the US dollar and the US Treasury, because that was a dramatic thing to do, to weaponize what is supposed to be a neutral reserve currency. So the de-dollarization story isn't just an exaggeration. The number of BRICS countries that are increasing in membership, including the United Arab Emirates, including Saudi Arabia, with have oil issues, have massive implications there. But also, it's not that they're going to necessarily have a BRICS-backed gold currency or for the BRICS, but they are net settling their trades in gold more and more. That's an obvious trend. The number of countries now settling or trade settling outside of the US dollar is extraordinary. In the oil markets too, again, the petrodollar since the '70s, which was very important to Kissinger and Nixon and Volcker, that we had this permanent demand for the US dollar. I've said many times it won't happen overnight, but there is a change in the US dollar's role in the oil markets. That unnatural demand, that forced demand for the dollar is changing. Last year, 20% of all global oil sales were outside of the US dollar. So now that would have been unthinkable in 2019 to say something like that. So that demand for the dollar is getting weaker, not overnight, but slow. And so all of these forces, what's happening in the COMEX, what's happening in the oil markets, what's happening with the weaponization of what was supposed to be a neutral reserve currency, what's happening with debt levels and the inability to pay them. And I think one of the more interesting things that's really on the table and is open to more people more and more is, since 2014, central banks in the East in particular, but in the world in general, are dumping US treasuries and they're buying physical gold. And it's not just because of, has nothing to do with the Ukraine war or de-dollarization from the BRICS. That's because of the extraordinary debt levels in the US. there's less and less trust for that dollar, and there's less and less trust for that IOU from Uncle Sam. All of these forces converge on the gold price. But again, I'll end where I started. It really, the 30,000-foot answer is throughout history, all fiat money gets weaker and weaker. All broke nations debase their currencies. And as Hemingway and von Mises and others said, it's usually inflation and war when a country's in debt. You see these cycles. The inflation and the currency debasement, there is simply no exception throughout history, no matter how far back you go. When a country is too far in debt, when it crosses the Rubicon of unsustainable debt, like the US has, and it's a great country, I'm an American, we're both understanding the qualities of America, but we're not exempt from the laws of math and history. And nothing is written in the newspaper that's owned by corporations, or nothing said by a politician that's bribed by lobbyists or trying to toe the line can change the fact that America is a banana republic balance sheet.
Yeah, completely agree there. But you said something interesting, excuse me, regarding the debt, because I think when we look at the GDP, we're hearing how GDP is doing fine, it's doing better.
Yeah.
But there's an understanding that a lot of the GDP comes from debt. And it's getting to a point where we may not even be able to pay the interest on that debt.
Yeah.
But they create the debt, and then they go ahead and finance welfare, finance warfare, all these things, and then it gets consumed back into the economy. And they say, there you go, look, companies are producing, but
Yeah.
it's really debt.
Yeah. No, it's a very good point, Patrick. I mean, to me, it's an oxymoron. Debt-based growth is not growth, it's debt. I have always used the analogy. I mean, if I give my son or daughter in college a credit card and they go out and have a spending spree with their friends at a fraternity or a party or a football game, whatever they do, and they're very popular and they're growing in popularity and they're growing in materials to throw parties and even places to rent, well, that's not real growth. That's not real success. That's my credit card. And at some point, someone has to pay the bill. And if I can't pay the bill, I'll have to find someone else to borrow from to pay the bill. Or if I had a money printer in my basement, I would do what everyone would do if they could legally fabricate money out of thin air. So your point is very well taken. The Fed and the policymakers in the US and in other countries, certainly in the ECB and Europe where I live, they say they're data dependent. They're looking at the data, but they're also data manipulative. And GDP, like labor, like inflation, are, in my opinion, and I don't think this is extreme anymore, that isn't objective, real data. It's manipulated data. And you mentioned rates too, and we can talk about rates and inflation. This is not quackery. This is, well, it's survival. I mean, I think if I were a central banker or a politician, I was trying to avoid unrest or more division, you try to put lipstick on a pig and use this data. But to your point, the simple answer is the trillions we've spent in fiscal spending, the trillions we've done in backdoor QE, whether it's through the Treasury General account or these supplemental leverage ratios that we're allowing, or whether it's the reverse repo markets, there is already indirect QE. But the level of currency debasement we've gone through and the level of fiscal spending we've gone through post-COVID, it's extraordinary. It's unsustainable. And so that kind of debt will buy you short-term prosperity, as Hemingway said, but it does lead, and this is not meant to be doom and gloom, it does lead to some type of permanent ruin, the evidence of which is sadly already around us.
How would you compare, let's say, the inflation that you see in Europe compared to the inflation back in the US? Is it similar, or
Yeah.
is anyone getting better?
Yeah, it's interesting. This year I've been in South Africa, North Africa, Canada, the US, Asia. It's the same question. It's an important question. It is felt. It is felt. It's irrelevant what a government agency or a Bloomberg report or a Bureau of Labor Statistics report tells you about 3.7 or 9.2 or 6.4% inflation when everything costs more. And it's I use the example of the GW Bridge when I used to live in New York City. The price of crossing that bridge would go from $5 to $7 to $10 to $15 over a short period of time. That GW Bridge metaphor is true in everything, though. It's true, and certainly in Europe and in the US too. Whether we talk about energy prices or wars, all these things affect energy prices, but there's also taxes on gas with or without crisis in the Middle East. There's taxes on food in different nations. But the bottom line is, unless you're in the very top 10% or the top 10% of that 10%, it's difficult. I see it in families that I speak to, I live in rural France. My neighbors are farmers and apple growers, and they have to make a decision whether they'll drive to Bordeaux or Paris because gas prices are too high or toll prices are too high. These anecdotes say a lot about the real world. And when I was in the US or when I was in Vancouver and whether you're talking to an Uber driver or a hedge fund manager, we're all talking about everything costs more. But when I was driving through the Midwest, the real America, Ohio, Michigan, to go see my alma mater or to see my family, you stop at a gas station or a toll booth and you talk to some people, you pass through a small town, you can physically see the stress, the strain. And when you leave your country and go back for short periods, you see the contrast. And every time I go back to the US, there's more and more frustration, more and more, I don't want to say hopelessness, but a sense of severe tension and concern. And understandably, many people don't have the time to understand central bank policy, currency, gold as a alternative to paper money, or even if they understood it, they don't have the luxury to buy a half an ounce or an ounce of gold every month. So it's more than theoretical, sadly, it's cultural. And then when cultures are stressed financially, they tend to divide. And then we have a lot of tribalism and division that's easily fed by financial stress. As I've said many times, I've heard it said to me, when you stand out in the rain long enough, you'll get in any car. You'll believe just about anything, either hopeful or cynical, and that's very divisive. And I see that in Europe, whether it's in Germany, whether it's in France, whether it's in Italy, whether it's in the UK. Certainly see it in Canada, whether it's in Vancouver or Toronto or Quebec. And it's not just a U.S. phenomena. And even Asia has some tensions and stress about towing the line versus saying what you think, or what's really going on, who's making the decisions, what freedoms, what powers, what financial powers, what political powers do I have. These things are very symptomatic of more centralization. And centralization always follows in the shadow or in the footsteps of countries that are broke and desperate and looking for more ways to control things.
You had mentioned the QE. When I take a look at the Fed's balance sheet, you see it going down, but yet there's a form of QE going on. So how are they offloading their balance sheet, yet still buying treasuries or some form of QE, so to speak?
No, it's fascinating. I mean, Wall Street and the Fed and finance is so wonky. It's so complex. It's meant to be so that the average, even financially educated citizen gets too lost in the derivative math of it or the political maze of it. And so you can get into the wonky things like the American Association for Derivatives or the FDIC and the Fed and how they're trying to pass another, again, like they did in 2020 during the COVID crisis. Basically, it's called a supplementary leverage ratios for the commercial or the Fed banks. And all that is a fancy way of saying it's going to allow the Fed banks to use unlimited leverage to buy US Treasuries. These are Fed banks, not the Federal Reserve. That's a backdoor way of taking the pressure off the Fed from having to do direct QE to buy Uncle Sam's IOUs. So that's one example. The other is the repo and the reverse repo markets to provide overnight liquidity. And then there's the Treasury General Account, which we've emptied and filled and emptied and filled. Again, these are basically what I call backdoor QE. But to your other point about the Fed tightening its balance sheet and raising rates, that's very temporary. They have reduced the balance sheet from its highs post-COVID. It's a tempest in a teacup. It's very little in the grand scheme of how big the balance sheet is, but that's also very deliberate in my view. If I were Powell, I would be doing exactly what he's doing. He tried this in 2018 to raise rates and tighten the balance sheet. It ended in a disaster by Christmas of that year, and in 2019, eventually we had permanent, unlimited QE. He's trying to do that for, my view is, Powell knows he's trapped. Whether he raises rates or lowers rates, whether he tightens or eases, whether he claims we're in a recession or denies we're in a recession, whether he uses data-dependent or data-manipulated inflation or strong labor versus real labor data, he knows he's in a trap, but he also knows that whether he wants to declare a recession or declare that he's in trouble, he wants to reduce the balance sheet now and raise rates now because those are the only real tools he has. And so when it becomes obvious that America is in trouble, usually when a market sell-off occurs, not when there's bankruptcies and unemployment numbers and it's in a hidden recession right in front of us, but when it becomes obvious that we need an emergency measure, he'll say, well, good thing I reduced the balance sheet, so now I can fatten it. Good thing I raised rates, so now I can lower them, because only a few years ago, he had no else, rates were basically zero. We've raised from 0 to 5 7/3 at a rapid slope, at a rapid speed. That was to reload that one weapon so that he can reduce rates when he has to concede defeat and admit recession. And if we can reduce the balance sheet on the Fed side, then we can fatten it. But in the meantime, behind the scenes in this TGA and in these other mechanizations, he is providing backdoor liquidity. And again, for the markets, for the bond markets, for the banks, not for the guy in St. Joe, Michigan, or in Ohio, or struggling. In other countries and other central banks are doing the similar kind of methods, kind of this hidden liquidity that's far too complex even for most guys who work on prop desks at certain hedge funds or banks in the past. So it's meant to be wonky, but it's just liquidity by another name, artificial.
Yeah, definitely it is complicated. That's why I'm happy to be able to ask you about it. But with the Fed, um, yes, they do need. Oftentimes we hear a 4, 5, 6% interest rate, a runway, so to speak, for them to back off of, and when that recession comes, they can lower that rate from a higher point.
Yeah.
But this time around, Powell was saying, he's going to start lowering rates earlier this year. It was, and now we're hearing maybe
Yeah.
September
Yeah.
he'll lower. You think he's going to lower, and if he does, is it going to be short-lived?
Many ways to answer that question. I always start by thinking, and we both can imagine and kind of laugh at this, the very fact that we have to think and predict and psychically analyze, psychologically and with tea leaves and a crystal ball, what will Powell do? The fact that Powell or a central bank has this much power over our fates, the fates of theoretical capitalism or the fates of our country, says a lot about the dangers of centralized power in a nutshell. But that's just a grand statement. The Fed is here to stay. I don't think it's going anywhere anytime soon. I wish it had never been born in 1913, but it's here. But we have to just step back when we talk about rates. First of all, just the fact that we have to sit here and worry about the great Wizard of Oz, Powell, or Yellen, or Bernanke, or whoever was, or certainly Greenspan, the amount of power that independent, non-constitutional entity has over our daily lives and over our markets and over what is ostensibly wealth inequality because of what the Fed has done. But to your specific question about rates, this is, again, where he's in a conundrum. He's in a debt trap. In Vancouver, the talk was in January, six rate hikes this year, and the markets were galvanic. They went giddy with the idea of lowering rates. When you lower rates, that takes the cost of debt pressure off companies on the S&P, the Dow, the NASDAQ, businesses on Main Street, consumers with massive credit card debt. The idea is certainly mortgage rates. The idea that just saying I'm going to forward guide rate cuts this year in 2024 sent markets spiking. And yet it hasn't happened yet. And here we are almost in May. I think to answer your question, I want to be honest. There's two ways to look at it. There is a case to be made that he has no choice but to reduce rates and that he will do something. It's already deep into 2024. We're probably looking, and I'm guessing, no one knows. Fortunately, I don't work at the Eccles building or hang out with Powell every day at tennis to know exactly what he's going to say. But guesstimating, I think the case why he will reduce rates is simply because Uncle Sam himself can't afford higher rates. Our debt this year at the current higher for longer policy, the interest expense alone on Uncle Sam's debt will hit 1.6 trillion. That number is extraordinary. It's frankly an abstraction. It's unimaginable. That's just Uncle Sam's debt. So if he doesn't raise rates, we hit what Luke Gromen and frankly the St. Louis Fed called fiscal dominance, where our war to fight inflation through higher rates will be inherently inflationary, because when you get that much debt expense, you're going to have to create money out of nowhere to pay the interest expense, which is inflationary. The argument against that, Powell will say, well, still worrying about target inflation. Inflation is whatever he wants to call it. It can be whatever percentage they want to make it up to be. That's a different discussion. But he could argue inflation numbers aren't where we want them. We're not near that 2%. I can't reduce rates. And that would be an argument why in the war against inflation, he'll continue this higher for longer policy. And Powell, I have many negative things to say about Powell, but I understand his position. He also knows his history. And Bernanke, when he was raising rates to fight inflation, tried to cut them too soon. It's called the Bernanke mistake. I'm confusing Bernanke with Volcker. My mistake. Volcker made the Volcker mistake when he was trying to raise rates in the early 80s and in the 70s into the early 80s. He cut rates too soon. And then we had a huge 7 to 8% surge in inflation in what he thought was the end of inflation. So inflation's conquered, I'm going to cut rates, and then boom, it piked back up. I think Powell was afraid of making the Volcker mistake. But the other thing, again, so Volcker is trying to balance this war of by the way, if I start cutting rates now, what do I do next? I'm running out of tools again. The other reason, though, Uncle Sam can't afford it, but frankly, the bond market can't afford higher for longer. If we stay at 5.25, 5.75, 6%, the spreads between junk and treasuries are going to widen. The companies on the S&P, there's over 750 billion worth of debt that has to be repriced this year. If they have to reprice at a higher rate, that's going to affect their margins, their earnings. That's going to affect the market. Next year, there's over 1.2 trillion in repricing of corporate bonds. So the bond market, which is everything, needs lower rates. And Uncle Sam needs lower rates. But if you have lower rates, you're conceding that you've lost the war on inflation. And if you have inflation that outpaces the yield on your treasury, no one wants your debt because you have negative returns. So it's all tied together. He's damned if he does, damned if he doesn't. And frankly, both result, in my opinion, in the end game is inflationary, no matter what. Whether he stays higher for longer, we print more we inflate more to pay our debt. If he reduces rates, the dollar gets weaker, we have more inflation, and we admitted we can't beat inflation. So, but again, goes back to the primary point. All nations throughout history debase their currency, and to Hemingway's point or von Mises's point, it goes to inflation and war. And what do we see all around us? Either direct or indirect, inflation and war.
You mentioned the point about the just the interest expense, how that's growing. I've read some reports where over the next decade, we're looking at 12 point something trillion with the interest expenses. That boils down to about 37,000 for every U.S. citizen.
Yeah.
How are people going to make ends meet?
Well, that's the skunk in the woodpile, right? This is how policies in DC and the central banks, the buck stops not with them, it stops with the average citizen, right? Because obviously GDP and tax receipts aren't going to pay for that. So they're going to, first of all, come up with excuses why they have to debase the currency and print more money. And that'll be a war, Putin, COVID, little green men from Mars, global warming, something to justify. Sadly, it's usually war to justify emergency measures, extreme spending, extreme inflation. They won't just admit that it's their own fault from going into debt to stay elected, or to get a Nobel Prize if you're Ben Bernanke, or to look better than you appear. Again, the lipstick on a pig. You can pay for everything. All of us would look more successful if we could legally print money in our kitchen to pay for all our expenses. That's not a sustainable policy. So to your point, when it gets to that cost per person, well, obviously those people don't have the money. The government doesn't have the money. They'll debase the money to pay it. But what does that mean? That means the loaf of bread or the gas tank that you have to fill or the rent that you have to pay is going to be even more painful than it is today. And unless wages, and they never increase at the same rate as inflation because they misreport and underreport inflation. That is why it's already happening, Patrick. It's only going to get worse. But that is why you see that stress on Main Street America or Hauptstrasse, Germany, or Rue de Victor Hugo in Paris, or in any French village, or in any place in the places I've been in Canada or Africa this year. So it's a global problem. The U.S. thought it was exempt from it, but it's also very much an American problem. And because the U.S. dollar is still and will be for a while the world reserve currency, its debasement affects everyone, which is why the BRICS nations are turning their back on it slowly. It's a process. It's why there's net settlements outside of the dollar, net settlements in precious metals. It's why central banks are stacking gold and dumping dollars in treasuries. And the dollar can still be relatively strong, but I always say I'm a horse person. I don't want the best horse in the glue factory or the slaughterhouse. I don't want to be the best patient in the ICU. I'm still in the ICU. I may be healthier than the guy or gal next to me, but we're all sick. And so that's not a happy ending just because the DXY or the dollar on a relative basis is stronger than some currencies and it is others. It is sadly a global problem. The debt levels we're looking at now in the globe, globally, are going to hit 400 trillion by 2030. Our GDP as a globe is 1/3 of that. It simply mathematically doesn't work. So currencies will be debased. Fissures will happen politically. War will be more on the headlines. In a nuclear era, that's very hard to understand how that works. And inflation will become the norm. And the best way to deal with inflation, if you're a politician or a central banker, is to lie about the actual numbers. So frankly, what any savvy, clever politician would do.
This de-dollarization process, and like you said, it is a process. I think a lot of people were thinking it's going to happen quick, and to our fault, a lot of us in the gold and silver space, we sometimes sensationalize the dollar de-dollarization. But you're thinking it's going to be a process.
Mhm.
Is it going to be a process that speeds up and eventually gets to a point where
Mhm.
we all feel it more than how we may not feel it right now?
Well, you know the expression of a frog boil, right? A frog can swim around and you can boil the water, and he doesn't know he's being boiled alive until it's too late. It's slow and then all at once, which is another Hemingway quote. But you know, Reinhardt and Rogoff, throughout history, it's economic theory. It's also kind of a quote from Hemingway. But I go back to Hemingway because everyone can understand that. You know, poverty or bankruptcy happens slowly, then all at once. And to your question, well, look, just not that long, gold was at 1,600, and I said, I'm not worried about the gold price in dollars. I'm worried about, I measure my wealth in grams and ounces, but I said, and I'm not saying this because I'm always right. I'm not always right. I don't know the answer to everything, but I know gold will go up because currencies are going to be debased. That was only a couple of years ago. Now we're at 23, 2,400. We're worried about 3% price moves, which are important. But again, it's impossible for me or anyone to time when gold hits 3,000 or 3,400 or 3,500, but it will be in my lifetime. So I'm not worried about the daily gold price. Egon, my partners and my colleagues, we don't sit there every day checking because we're not trading, we're not swapping, we're not arbitraging. We're just sitting there simple stupid. And our clients are sophisticated people, but it's simple stupid. We just know that whatever currency, be it a euro, a yen, or a yuan, or even a Swiss franc, and certainly a US dollar, they're just going to get weaker. And so I think when you even see Goldman Sachs or the commercial banks projecting 2,700 gold, then you know things are happening. But in a lot of ways, silver is a different story. Of course, it's not for widows and orphans, as Egon would say. It will have its moves. I'm not here to predict when. I know that the dollar will get weaker. I know that the forces at the COMEX are getting weaker to stop it. And I know that gold will go much, much higher. And I really don't need to worry about, I say, it's like if you're a turkey in a farm in America, we have Thanksgiving every year. You know, for your viewers who don't live in the US, we have Thanksgiving. Every year a turkey gets slaughtered for Thanksgiving dinner. And if you're a farmer feeding that turkey and the turkey thinks the farmer loves him and the turkey thinks everything's fine, the turkey doesn't need to know what day is Thanksgiving. But if that turkey knew that at some point the axe is coming, it's simple, but I don't need to know what day the axe comes. It's already cutting slowly at all of us right now. It's already what's happened to the dollar's inherent purchasing power is already evident. Since 1971, the dollar, all the major currencies have lost more than 98% of their purchasing power when measured against gold. And I was just this week in Singapore at a very sophisticated gathering of sophisticated investors doing private equity and venture capital and real estate and arbitrage plays and alternative investments. And they're talking about their rates of return. It's fascinating to me. And I come from that world in Wall Street. And I'm not mocking it. There's all kinds of ways to get 8% annualized or 7 or maybe more. But you're still measuring that wealth in an ice cube that's melting, in a currency that's melting. And I showed a simple, I mean, you can show all kinds of graphs. But it's a simple example that anyone, whether you're a family office in Singapore, New York with hundreds of millions of dollars, or whether you're struggling to pay rent in Milwaukee, we can all understand a simple story. In the 1920s, in 1920, the average U.S. home cost $5,000. Today, the average U.S. home is $500,000. But in 1920, if you had 20 or 250 ounces of gold, these little things you held in your hand, 250 of those in a shoebox, you could take that shoebox and you could buy a $5,000 house. In 2024, you could take that same shoebox of those little coins, those 250 ounces, and buy a $500,000 house. Same coins, still get a house. But if you had only had a shoebox of $5,000 in cash from 1920, it wouldn't even pay for the driveway or the landscaping in an American house. In other words, the gold, as they famously say, which does nothing but stare back at you. No, the gold is very, very, very busy doing nothing but retain its value as a store of value. That is not sexy. It's not as sexy as NVIDIA or Lucent or Qualcomm in the 90s when I was trading stocks, or all the ways you can get into, or even Bitcoin. It's not as sexy. It's boring. It does nothing but retain its value. Meanwhile, that shoebox of dollars is extremely busy, being traded all over the world. But what's it busy doing? Losing its value every single day. It's death by 1,000 cuts. It's so simple, stupid. And it's funny. And I talk to people doing secondaries and doing private equity deals and looking for the right jurisdiction and looking for the right return. And God bless them. That's what they have to do. That's what we were paid to do in family offices and in banks. And we went to these fancy schools to learn all the lingo. But we're really just playing with ice cubes and measuring our wealth in ice cubes that are melting. I don't suggest, and I'm not saying that gold solves all the problems in the world, or that every other investment outside of gold is stupid, or that you shouldn't look at all the other investments. I'm simply saying, however you measure your wealth, whether you're a shoe shine boy or whether you're a hedge fund manager. You're measuring it in some currency that is mocking you every day because of the policies of your government. And anyone can understand that, I think. And that isn't gold bug crazy. It isn't the end of the world. It isn't the end of the dollar. It isn't the end of the world reserve currency. But it's already happening, Patrick. It's been happening at a rapid pace in the last few months. But this is just chapter one for gold's move. And I'm not saying that as a speculator. I'm saying that as someone trying to preserve whatever wealth I have or whatever wealth anyone has. And it's really been happening since 1971 in particular. But we, again, see this throughout history without exception. You've got to protect your money. Paper money is not really money. You've got to have metallic money, monetary metals. They have an infinite duration, but a very finite supply that cannot be said of a dollar bill that can be printed by the trillions. And so it's common sense. It's not gold buggery. It's simply common sense.
Basically, wealth protection, it's not about the amount of dollars in wealth. It's about the amount of grams and ounces
Yeah,
of
exactly,
gold.
exactly. That's how I see it. That's how we see it at Von Greyerz, and it's how Egon understood it many, many years ago, and how families throughout the millennia have thought of this. They've always, and my family comes from Europe during the wars. My grandfather would say, "You need gold, oil." I mean, he said, "You need gold, real estate, and art." Now, again, not every person struggling to get through the month can afford gold, real estate, and art. I get it. But when you go through traumas as a nation, as a family, as a cycle, if you're paying attention, hopefully you pass that wisdom on to other people. Again, it doesn't mean that you can't make it as a dentist or a lawyer or as a mechanic. It doesn't mean you have to only think gold, but you have to be realistic about how you measure your and protect your wealth, whatever your background is. And now we are at a point, and I grew up through in the best of times. We grew up in the 80s, the 90s. Those were good times. It was good to be an American, good to be European. My kids have lived on a silver spoon most of their lives. But I remember, as my grandfather and my grandmother reminded me, don't become complacent. Doesn't mean be negative, doesn't be on your knees waiting for the end, but understand that the only thing that changes, the only thing that we can always be certain is everything changes. And it doesn't have to be a terrifying change, but it already is a very traumatic change right now. What I see in the cities in Europe, what I see in the faces of people, what I see with the currencies, what I see with measuring your 5 to 20% annualized return on a currency that's already underwater in its inherent purchasing power, when you add actual inflation on top of that, you're literally running uphill in roller skates. You are just you're on a hamster wheel just to get through the month. And even the ultra wealthy who hedge or think they have paper wealth in markets that can be illiquid in a day's notice, I'm not here to time it. And we could talk about markets, but that's not real wealth either. They're just going to be relatively better off than most people. And that small minority of people, it includes many people that I work with and who myself are. It's not even healthy for that small minority to measure their wealth in that. And it's not even healthy for there to be such a small minority of people with real wealth, while the vast majority don't have it. That creates natural resentment. It creates division. And historically, it never ends well, even from the people that have been prudent. So there's so many ways to look at this, but we've had the greatest stock bubble in history, in my experience as a trader, but it's only a benefit of the top 10% of the population. That is another problem with the mistakes made by a centralized capitalism, which I've always said is just feudalism.
Definitely, we will talk about the markets next time. But for now, I know you got to head out, and I just want the people to know how they can follow you on social media and tell us a bit about Von Greyerz Gold Switzerland.
Yeah, Von Greyerz is the largest gold and precious metal provider and advisory service for high net worth clients in the world. We have clients from over 90 countries, and I say outside of the commercial banking system. We do not believe that commercial banks are the safest place to hold your gold for a number of reasons, and we don't believe in paper ETF gold for a number of reasons. All of the reasons that we state are not sensational. They're written about on our website, and there's a whole page dedicated to answering these questions objectively. And that can be found on vongreyerz.gold or goldswitzerland.com. All of our tweets, all of our articles, all of our interviews, and years of keyword searched reports on these themes can be found there. And again, you don't have to become a client of Von Greyerz. We realize that 99% of the people watching our interviews or reading our materials don't necessarily have the millions to spend on gold. We still want them to understand gold. It's very important to Egon and our entire team and myself not to scare, but to educate. and it's very important to have debates and to exchange different views on inflation, no inflation, deflation. There's very good things to say: strong dollar, weak dollar, recession, no recession, gold, silver versus fiat. All these important topics. We try to be sober about these things, and we try to spread this information to as many people as possible, so at the very least they're prepared and they understand what's happening around them, rather than just feel like a twig in the river being tossed around by invisible forces.
All right. Well, Matthew Piepenburg, I want to thank you for coming on over to the house. I think you gave us a lot of good info where we can take a step back and look at things from a different altitude elevation. So thank you once again.
Thank you, Patrick. Thanks for inviting me. It's a pleasure.
That was Matt Piepenburg sharing his views on the economy and gold. To see more of Matt's views, go to www.vongreyerz.gold. If you like this video, please do subscribe, share, and give it a thumbs up. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.